Welcome to the latest panel. Again, I've got details on my phone of what the subject is, M&A in the current context. We're joined by two of the panelists who were on the big stage earlier. We've got Julian here from RB Capital and Tim Heath from Yolo Investments. And then we're joined also by Bonavent, Gauci at PwC, and Tsachi Maimon from Aspire Global. Right, so M&A has already been discussed on the big stage, effectively, and we're in what is an extraordinary era for M&A. It's simple as that. I don't think I was just saying to Tsachi. I mean, I've been following the industry for many years, too many years to mention, and I've never seen it quite so full of activity as it is now. Julian, what's going on?
It's a bubble. Simple as that. I think it's tempting to think that there's a big wave of M&A that's at some point going to stop or consolidate. Truth is, as you've probably seen, there's been the last 3-4 years have been a gradual ramp up of M&A, right? And they've become more outrageous with every passing year, right? I mean, we just saw the Score being bought by Penn, right, for $2 billion. And that's just an eye-opener of where the industry is heading. And that's just in the US. There's a whole lot of M&A activity happening under the radar that nobody talks about, right? A lot of pre-regulated markets where there's activity going on. And one of the main drivers is that capital is cheap. It's very cheap right now. Inflation is thankfully leading to some of the cheapest interest rates, which allows bonds to be used for acquisitions to be quite cheap. Good for brokers like us because we get involved in a lot of the transactions. But there's, some would say, a heating up of a bubble that might very well consolidate sooner rather than later, if that makes sense.
Yeah. Tsachi, you've just completed a deal for multi-millions. Do you think it's a bubble?
No. When you do an acquisition, there is a trigger for an acquisition. It's either you want to have an access to a market, and to have a faster access, you are doing an acquisition. It's either you are challenged by the regulations, and then your revenues are going down, so you are doing an acquisition in order to overcome it and to continue the journey. So depends what is the trigger. If you are a public company, so we call it in a joke, you want to feed the beast. And this is also maybe a trigger for a wrong acquisition. But I don't think that it's a bubble. A lot of markets are being opened right now, licenses, not only in the US, but overall. So companies want to be faster and to create a position fast.
And I suppose to an extent, it doesn't matter whether it's a bubble or not. The fact is there's momentum here. You've got a lot of money chasing opportunities globally. Obviously, US is probably the predominant opportunity, but there are obviously a lot of opportunities elsewhere. Tim, does this momentum, is it just self-perpetuating at the moment? Is that what it feels like?
Look, I'll take a different view here. I'm looking more at the early stage investments of new businesses coming out. We're getting 200 pitch decks a month. There's a lot of crap in there, no doubt about it, but there's a lot of very good ones, whether they be US startups, whether they be European startups. There is a cyclical stage where people will exit and be bought, and then they'll look to start a new business, or they might have been part of a company and they can see how it's done. So we're seeing a lot of people still wanting to try and grow a new business, innovate, get through that first sort of 3 to 5 years, and then there will be an acquisition stage coming through where the likes and some of these big American companies are buying, which is giving a bit of a false valuation of that FOMO I talked about earlier. But there's certainly, it's cyclical in that sense, and as capital's there and as markets change, there is consolidation. So there's always going to be buyers out there for good young products which are EBITDA positive, and they're ready for action, and they're not ready to take their business to the next level. It's actually the right time to sell out or to join a bigger brother, if I can call it that. So it's certainly, there's activity there.
I think that's right. Actually, building on Tsachi's point as well, I think there's some reasonably well-capitalized businesses, right, that have cash in the bank and need to invest them, right? And this is the time to invest. How do you invest? You either take a position in early stage ventures, or you acquire pretty much mature businesses because they're going to help with your deal flow. I think in those cases it makes sense because even then the valuations themselves are justified, right? What isn't justified is when you get this FOMO, right? I think Tim put this. When you're such in a land grab, right? We're seeing this in the US, to be able to acquire players at let's be honest, sometimes at an unreasonable cost, that you end up paying a premium. And because of that premium, then you need to be clear about how your earnouts, i.e. how you're going to get paid down the line, is actually going to be structured, because you are essentially basing your initial payment on future earnings, which in itself poses a risk, because you're assuming that the future is going to be better, if not the same as the current situation, if that makes sense.
Bonavent, what are you looking at the moment in terms of M&A and the kind of businesses that you're talking with?
Yeah, I mean, I concur that sort of over the past year. I mean, there's been a lot of activity. From a point of view, we see a lot of companies trying to consolidate, to try to acquire companies to speed up the regulation process. So I mean, acquire companies in countries sort of where the company would already be regulated, and therefore that would speed up the process of growth. I think the way I see it is that the cheap capital combined by the opportunities in the US, Latin America, and regulation in certain countries in Europe, that is in itself creating sort of a lot of this activity as companies try to benefit as much as possible from the opportunities available in the market for growth.
One of the things that, when you talk about a bubble, are you talking about, do you think you're talking about the people who've lost sight of fundamentals in this? So the valuations are high end,
Yep.
at the high end, and also...
Depends when. Well.
And depends who, right?
Depends where.
So there's a good example of an acquisition, right? So Aristocrat, right, bought Playtech for actually a reasonable amount of capital, 11.5 times EBITDA. It's actually quite good, right? It's measured, and importantly, it is something that is based on fundamentals. When you see what Penn paid for the score, right, which essentially is $2 billion based on future earnings, of which analysts think at most next year will be $40–50 million revenue, then you start to question how far down the line are you basing these fundamentals to continue. That, economically speaking, is a bubble. Why? Because it's like when you buy property, right? Some people buy property on plan because they assume it's going to be worth 2 or 3 times down the line, right? But what if it isn't, right? This is what happened in Portugal, this is what happened in Iceland, this is what arguably is happening in Malta as well. That's a bubble. Now, how and if it gets called is a different matter, right? There have been bubbles we haven't yet called the top of. But economically speaking, they are still a bubble because they're based on that human instinct, right, of desire of wanting to be put in the midst of the excitement, ergo FOMO, if that makes sense.
Yeah. I think, if we zoom in on Penn National, it's a good example. I think that the acquisition was not purely high multiples on their performance. They didn't acquire them for their performance. They acquired them in order to, one, to stop paying Cambi and Whitehead between 50 to 100 million euro a year, so multiply it by 5 years, it's already a lot of money. Yeah. And second, to control the roadmap. So now they own this product. So I think that in some acquisitions, we need to, even though it seems, wow, they bought it for a 1,000 multiple, it's not the multiple inside. It's true, it's very high, but it's also going to save them a lot of cost in the next 10 years.
But that's also assuming that that cost is actually then going to have a return on investment. You're assuming that that market's going to increase, your acquisition costs will streamline, you can continue to acquire players across sportsbook and probably casino cheap as you do right now. And if you don't take control of those fundamentals, then at some stage you will realize that the initial outlay is way, way more expensive than what you're getting. And I always go down to fundamentals, right? Because when we're in the transaction process, and this is something Bonavent probably can recognize, there's so much of what we call EBITDA capitalization, right? You're looking at the balance sheet, you're saying, okay, if you're an affiliate, how much is it costing you to actually acquire players? If you're an operator, where is your upstream cost? How much are you paying the platform suppliers, right? That actually you need to come down to fundamentals, right? Whether you're representing buy side or whether you're presenting sell side, because you need to come up with something of tangible value both for the buyer and the seller. And if that isn't articulated well, Tsachi makes a good point, maybe for the score, it's actually to own your own stack down the line, right? You own your own stack, Americans love tech, so eventually you're owning a whole asset. If that is the mandate, and you can prove that mandate to your shareholders down the line, and it is articulated on paper, and you can calculate it, that is good. If not, and it's happening a lot right now, there's a lot of fear of missing out on an acquisition, especially in a market that's rapidly having a land grab like the US. Ergo, you will gloss over certain things, right? And it's happened before. I mean, there's lawsuits right now happening across some very publicly acquired businesses just because the DD wasn't accurate, or at the very least, some people just grayed over what territories they were representing and what not. That has to be part of the DD process. That has to be part of what essentially is the indemnities and the warranties. If not, then everyone's going to have a problem down the line when this ultimately gets uncovered, if that makes sense.
But I think it's also interesting, what's fueling the M&A growth at the moment is that these companies in America are looking to try and own that full stack, and maybe the real estate where the eyeballs are as well, to nearly defensively control that market as it opens up. So they're not buying revenue, they're buying, I need a full stack. So Gan and Coolbet, Gan needed the sportsbook. Coolbet had their own sportsbook. It's hard to build one. Let's buy it, let's get the revenues from their B2C, but we also then structure ourselves to move forward into that market as time goes on. There's a lot of slot companies being bought in America because everyone needs content to take into that market.
Does that bring, that also means that the execution is going to be very difficult on a deal where it's based on a promise, effectively?
Yes, and more so than that, how do you bring the synergies between two very different companies? And I think that the Aristocrat Playtech one is going to be a fantastic example of how do they fit together. Good luck. So while on paper it makes a lot of sense, from a full stack and a eyeballs, real estate makes sense, you've actually got to work together and put that business together to make it, help it make money. But it is certainly fueling some of the desire for M&A there.
I think the challenge is often, I mean, a lot of deals are based on earn-outs, but then a lot of these are also done to acquire synergy. So acquiring a company and integrating it as much as possible with the rest of the business to try to benefit from synergies. So the challenge is how to, in a way, respect sort of the business as a standalone, to be able to quantify earn-outs, whilst at the same time sort of trying to benefit from synergies, which would only come, and they're difficult to measure, and where they might be realized in the acquirer rather than the acquiree. So often there is a bit of that is challenging.
Yeah, because one of those phrases that as a journalist I just tend to write down and not question is revenue synergies. Could you explain what that might be?
I don't know. I wish somebody would explain that to me.
Yeah.
I remember reading this on the Flutter FanDuel, 3 years ago, and they were promising revenue synergies, EBITDA synergies actually, of 100 million per year.
Yeah.
And now FanDuel is thought of being spun out by Flutter, right? Because they don't necessarily think that it's true market value when you compare it to the likes, say, of DraftKings. I think this whole synergy, right, or let's call it less than accounting principle, is a challenge when you get to ultimately qualify it. It's not quantify, it's actually qualify. What does that mean in the greater scheme of things? How will you achieve that, right? It's okay to say, I'm going to get this top line number. It's how you actually do it across a roadmap of 2, 3, 4 years. Especially if a roadmap is involved, right? Sorry, if an earn-out is involved. Because if an earn-out is involved, that normally means that the asset you're buying has to work on specific targets. Those specific targets can be revenue, but they can also be EBITDA, or they can be FTDs, right? First-time depositors, or they can be geo. But the point is there has to be some degree of tangibility. And let's be clear, this is just the public companies we're talking about. Private companies do the same, right? But they're just not held to account, so to speak, by the press. There's an agreement between buyer and seller that normally is not necessarily disclosed too much, which essentially says by the end of year 1 you would have done X, and for X you're going to get Y. If you don't, then you might get half Y or no Y, right? So all of that needs to be qualified up in advance, because if it isn't, then all these promise of synergies just won't materialize, if that makes sense.
I can explain for Aspire Global. How we look at the revenue synergies. So we acquired Pariplay 2.5 years ago. Until we bought Pariplay, we paid for aggregation fee for other third-party aggregation. Once we acquired Pariplay, we stopped paying them. We are now paying Pariplay. It's still a cost from one of the companies, but it's a revenue in this company. And if it's a revenue in this company, it's a revenue in the group. It's the same also with BtoBet. We acquired BtoBet less than a year ago. So now, instead of paying third-party sport, we are paying internally. So it's an internal payment, but it's a revenue over there. So this is how we calculate the revenue synergies, because it's not only a saving cost, and then we develop it. It's also counted as revenues, and if it's counted as revenues to the daughter companies, it's also revenues to the group.
Yep.
I think last panel I forgot to ask if anybody wanted any questions from the audience. So I think there's a microphone that can probably be handed around if anyone does have a question. I can't quite see that well, but if anybody could raise a hand or otherwise dance about, then we can get a question from you.
There's an interesting one I want to talk about here as well. Given what's happening, say, take Germany at the moment, I think a lot of companies need to say, are we going white? Are we going to go grey? There's no double parallel track anymore. So there is a lot of M&A happening. If someone does want to go white, they want to sell off the grey, there are a lot of buy side coming in for that at the moment. Or people will sell off white and then concentrate on grey. It's very hard just to be a catch-all these days, and that's also fueling a lot of M&A queries. Yeah,
well, that's a question, because I know that in a previous call, Julian, you mentioned the word black market as opposed to grey market. And I think is it fair to say now that Germany is now a black market if you don't abide by the regulations?
It's blackish.
Blackish.
Yeah. Yes.
I mean, yeah, it's a black market. We'll just call it a black market for now.
Right.
Now that change, does that and you said before that there'll be M&A in.
It's not a black market. It's a market that now going through a transition period. You are allowed to work in this market if you are meeting the requirement. The companies that are not meeting it are working in a black environment. The market is not black.
No, sorry, yes.
And Netherlands is the same, let's be clear. So
yes,
it's not just Germany.
That's absolutely right, yeah. Thanks for the pointer there. But yeah, so you have a regulated market in Germany, and you work within that, and if you work within that, you've probably seen your revenues tip by 80%. If you work outside of that, you're then working in a black market environment in the biggest market in Europe. And if you're looking at that, there are presumably opportunities out there to either go and acquire the customers that have been dropped by the white, or you know, they didn't want to drop, but they've had to drop, or you can go and acquire their business in some way.
Yep.
Is that those conversations? Are those the conversations that are happening?
They're happening a lot, and the reason is this: let's take affiliates. Affiliates is a great example in Europe. Affiliates have always historically tried to push the edge of what is regulated, what isn't regulated, and what they can acquire and get away with it, right? And they've always been quite savvy, right, in terms of pivoting their acquisition techniques towards territories that give them the highest LTV on CPA, right? Every good operator shouldn't look at LTV or CPA. They should look at the ratio, right? And affiliates have been exceptionally good at that because they negotiate good reward plans with the respective operators. What's happened recently, because of the shift in regulatory waters, so to speak, is affiliates are now starting to question, what are we going to do next, right? So an option is to remain grey, and grey by definition is you operate in a territory that right now has no regulation, as opposed to, say, Germany or Netherlands, where if you are operating there, you either have a license or you don't. If they continue to do that, then arguably they have some form of shelf life, right? As long as you can continue finding grey markets and moving towards grey markets, then you have arguably a life. And because right now regulators aren't looking as much on affiliates as they are on operators, they still have some sort of life. But affiliates then say, actually, hang on, maybe I should quit whilst I'm ahead, right? So you get a lot of these M&A transactions, right? A lot of which remain under the radar, which are essentially around acquisitions that you never hear of, but are very good affiliate networks or PBNs or aspects of, let's say, white hat and little less than white hat SEO that allow players to continue to be discovered. That's just one aspect of M&A. The other aspect of M&A is some grey label operators who are working in territories outside of Europe, who enjoy working in those territories, have a risk profile that understand the specifics, nuances of working in those territories, and are happy to continue or want to sell. Now, the difference in valuations will be significant, right? You will never command a grey or a blacklisted operator with the multiples as you would for white. But the point is that there's always going to be a market for that, if that makes sense.
Yeah, okay. In that environment of where Europe has been, people working within the European market have been used to that argument about black, grey, and white, and that's been a long-running debate, and that has informed a huge amount of the M&A deals we've seen over the past decade or more, and it's always been part of that conversation. And even, I think, like you say, even the Playtech deal with Aristocrat has that element of what's Aristocrat going to do with the grey market in Asia and various other markets it's got. But when it comes to what the US looks at and US investors look at, are they looking at the same? Are they looking at those same metrics? And do they not care about that so much? Would they say, I'd rather not invest in a grey market, and therefore?
So it's a good question, because this year we did 3 transactions to US-listed buyers. US-listed buyers have different requirements to European buyers. But one thing they are very, very, very clear on is that the metrics have to be white. Fine, you need to change your accounting standards from GAAP to IFRS. You need to make sure that the specific licenses are all fully applied for. The tech is properly capitalized and whatnot. But one thing that the American buyers right now are definitely looking for is traffic that they can account for on their balance sheets. Traffic that they can and will be held accountable for, but importantly can report on. I don't know if that's your experience as well, Tsachi, but...
My experience is correct in the aspect of the buyer. You're totally right. They are looking not to take a lot of risks. But I think that from the investor's point of view, those shareholders that buying the stock in the US, I think that they are still not educated enough to understand, okay, I see revenue, I see profit. If it comes from Ireland or Virginia, I'm not sure that they are looking that deep. They will, as they will be educated that if the company will not generate, as Julian said before, if they will not generate profit later on, so probably the valuation of those companies will decrease. But I think that at this point, the shareholders and the investors are not that specific to the source of the income.
That's very true. In fact, if you look at how institutional investors and even retail investors perceive iGaming, it is just one of those COVID defensible stocks that didn't really change last year. In fact, Round 3 has just put up a new ETF that just tracks gaming stocks, right? And it's specifically geared for the persona that Tsachi has outlined, right? These retail investors that don't really care about the underlying asset, they just see a return, and they want to ensure they capitalize on that return. Whether that changes in the next 5-10 years will actually come down to platforming. And by platforming, it means if anyone's going to have a say in a specific asset in a specific market, what's happening with Facebook right now is a really good example, right? We get this whistleblower who's actually talking about the bad practices that's actually happening across social media. At that point, will retail investors stand up and take notice? But until then, I'm with Tsachi. I actually think people especially won't care unless they're specifically buying the whole business.
Tim, I was interested in what you said earlier about you're looking specifically at smaller companies that are startups or growth companies. And I think from a recent newsletter we wrote that there's something like 160 million that has been pledged publicly by various funds in the US to look at startups and growth companies. What's that going to do? What's that weight of money going to do when it comes to the companies that you're talking to and what their prospects are, and more to the point, how they see their prospects from this point on?
Maybe give founders an overvalued or overheated expectation of where they actually are in their life cycle. That's just a conversation we need to have. Actually, comparable transactions we do, this is where you are as a SOT company in your life. This is where you are as a B2C in your life. This is where you are from our metrics that we sort of benchmark across I think there's a lot of money being raised in America on these ones, but I think there's a lack of experience in America to understand how to grow those companies correctly. I think it's still, we're in this acquisition life cycle stage in America, and it's like, and we need content, but we need more real estate. No one's actually, how do we refine the efficiency of a business? Because I'm sorry, DraftKings and FanDuel are not efficient businesses, losing, what was it, 1.2 billion last year. That's not an efficient cash positive business. So whilst we're in this early stage, yes, there will be a desire for startups coming out of America specifically, and yes, they're going to find. We did one into a DFS one, Thrive Fantasy, recently, and there were some very interesting other investors into that as well. Personally, I'd never heard of them, so we got to have a chat to them and talk about deal flow, but they seem to get money early from America, but then looking sort of to Europe for experience of how do we now grow this within the iGaming sector. And I think that's where European money can certainly help.
Because the fact is that I think it's been touched on before, but you mentioned it on the big stage, but the US is much more attuned to investing in technology, and it's much more attuned to investing in risk as well in terms of young companies. Does that change the metric from what you're used to in Europe? Are you seeing people coming across and you're looking at the European scene and looking at that as a huge opportunity, or is there some other aspect of that changing?
So, and I also think Tsachi mentioned this as well. Tech is especially enjoyed by the US because it is more quantifiable. You can articulate the value of it. But especially if you're an operator or some sort of entity looking to acquire tech, you're aiming towards building a full stack where you don't need to pay attribution costs or upstream costs or licensing to anyone else. You own that. That inherently increases your value. But then in so doing, you need to make sure that the individual parts of the supply chain are all happily working with each other, right? And importantly, if you're buying them and you're a public company, you need to make sure they're all quantifiable and accountable. That is a challenge in itself, right? And this is why we're seeing these high valuations. At the end of the day, it's all an expectation of future growth, right? I'm building this massive Lego truck, right, of these small pieces. But this Lego truck is going to be so great, I'm already starting to pay premium on the pieces I'm building for it. So there's a massive layer of expectation that's layered up with every single transaction, right? Where does Europe come into this? Europe comes into this because effectively it's got tried and tested tech, but also tried and tested acquisition channels, right? The Caesars William Hill deal is actually quite an interesting example, right? Caesars wanted to understand William Hill's online assets, but importantly, they knew how William Hill acquired as well. That was a skill set that Caesars does not have. So that transaction does make sense. But importantly, then the synergies that then work across the line. See, I use the word synergies because then you can quantify that, right?
Tsachi, does it make sense for B2C operators to try and acquire tech? Or would it, and I'm playing to your strengths here, but presumably you would say no, that they should outsource it. But you can see the driver, I guess.
It's a great question. It's a question that I believe every B2C operator asking himself every day. Should we acquire the technology or not? I think that the size of the B2C and his ambition should be a reasoning if to acquire his technology or not. Because if you are staying on a certain level, you can see the technology as an hurdle that defocusing you from the vision that you have. But if you are becoming too big, so then probably you want to have it on yourself and to control your destiny. So, for example, in the US, it's clear that the Big 10 or the Tier 1, if it's not now, but in the next 3-4 years, they will own their technology. So, for example, in the US, technology companies that will target only Tier 1 will collapse. So this is our vision in the US, for example, is not only the Tier 1, or mainly not.
Is there also an opportunity around the tech stack is a term that's used to describe an online sports betting operation, for instance, and there are a huge amount of elements that are plugged into that you might not recognise, that other industries don't face in terms of what is, where does, you mentioned data companies before, where does an odds, a company that manufactures odds, where does that fit into the tech stack? Is that part of the tech stack or not? That kind of a very fragmented landscape. That presumably leaves opportunities for smaller companies to...
Yeah, it's a good point, and it's an interesting one. Should a B2C own their own tech stack? If you've got no ambition to sell, you can't just sell players and a brand, I don't think. Or you can, but you're not going to get much for them. If you've got this tangible asset, Coolbet, again, is a great example of selling their whole technical stack. I'm trying to work out whether OpenBet was the one you're referring to, Tsachi, not being relevant in the future to the tier ones, because they do provide a sportsbook to a lot of different operators. But can these big tier one operators just go and build their own tech stack? It takes 12, 18, 24 months to do it, and there's a lot of learnings, and it's a fast-moving industry, maybe acquiring and bolting in, but then William Hill for many years were acquiring, and DAFA, for instance, acquiring different things, and you're piecing together a jigsaw puzzle. You're not going to have that synergy you need, that if you do own your full tech stack from top to bottom, you can find your own USPs going out to the market, which you cannot if you don't control your own CRM. Yes, there's the Fast Track, there's the Braze, there's the Optimove, 3 great products, but actually any operator should be really trying to do that themselves to understand their customers better and customise it to try and find their USP in the market. That said, not everyone can do it, so there is an opportunity for small companies to come through and say, we can do this element of your life cycle brilliantly, and we will charge for it appropriately, and then we will be acquired by a bigger essence of that part of the life cycle as a very good service which can be provided.
If you were involved in discussions between Entain and DraftKings, and presumably MGM are presumably part of that discussion, where do you think that's heading?
It's an interesting one. I'm happy to take a first stab at this. There's this developing story, right? Will they, won't they, right? And arguably, a lot of all 3 stakeholders have to gain from whatever's going to happen over the next 30 days now. So MGM has the opportunity to actually take back the whole BetMGM platform, right? Because they have a 50% call option, but they also have a veto vote, right? So they might actually force DraftKings' hand to actually say, we'll only okay the deal if you actually give us BetMGM. And BetMGM right now, I think, is the 2nd largest sportsbook in the US, right? So they're commanding very big presence, so they might actually get the BetMGM platform on the cheap, particularly if they okay a deal that for them actually is expensive. Whereas DraftKings right now is on a massive acquisition spree. This year and probably next year as well, they would by far be the biggest acquirer, unless Evo is really going to kind of anti the game in Q4. So it's arguable that DraftKings will continue to just see this deal through, almost because they have an agenda to prove, right? The 22 billion now valuation is something which is an excessive premium, right? Even though, ironically, at the time, Entain turned down an offer of half that less than a year ago because they said it wasn't high enough. So I think it's all to play for, but I genuinely think that the dark horse here is MGM. I think they stand to gain from the BetMGM. I don't know what you guys think.
I think that DraftKings will go all in on this transaction. They don't have a lot of choices. I think that the size that they reached with the loss, as you said before, the loss that they have, even if they will do 5 acquisitions next year, it will not be the same size of this one in order to show a little bit profit to their shareholders. Because I think that the next year will be dramatically important for DraftKings to show profit. And BetMGM or GVC, this is their only way, because of the size of them, to give them the profit that they want. 5 acquisitions next year will not give them what they need. So this is why I think they will go really all in on this one.
And do you think even if they go all in, could they still lose?
Again?
Even if they go all in here, could they still lose out?
Of course, it's too much, maybe.
Yeah.
And then they will be in a cycle of being with a big debt.
I think it boils down to fundamentals, as we're saying. I mean, if they pay too much, I think they'll never recover that. So.
Well, I think to Tsachi's point, I think they're pot committed now. They've shown their hand. They have no choice but to go all in, and this is what concerns me about a bubble, right? This is what the FOMO stack is all about, right? They have no choice but to see this through, and then some, even for next year. But I agree with you. I actually think they won't be spending as much next year as they have this year. I mean, who cuts those checks anyway? I mean, it's incredible.
Issue shares. Then it's free. Is DraftKings wanting to buy the revenues that Entain enjoy around the world, or they want to buy the tech stack? I think that's the first question.
Only the profit.
Only the profits.
Only
not
the
tech
profit.
stack.
500 million of profit. This is what they need. They need cash.
Yes.
So MGM end up with the tech stack.
Yes. Quite likely.
Okay. I think we've probably covered that one. Thanks very much to the panel. That was really interesting chat. Julian, Tsachi, Bonavent, and Tim. Thank you very much, and we'll speak to you later. Thank you.
Yes.